Finance teaches that managers' primary goal should be to maximize the wealth of the firm's owners, the stockholders. The simplest and best measure of stockholder wealth is the firm's share price, so most textbooks instruct managers to take actions that increase the firm's share price. A common misconception is that when firms strive to make their shareholders happy, they do so at the expense of other constituencies such as customers, employees, or suppliers. This line of thinking ignores that in most cases, to enrich shareholders, managers must first satisfy the demands of these other interest groups. Dividends that stockholders receive ultimately come from the firm's profits. It is unlikely that a firm whose customers are unhappy with its products, whose employees are looking for jobs at other firms, or whose suppliers are reluctant to ship raw materials will make shareholders rich, because such a firm will likely be less profitable in the long run than one that better manages its relations with these stakeholder groups. Therefore, we argue that the goal of the firm, and also of managers, should be to maximize the wealth of the owners for whom it is being operated, which in most instances is equivalent to maximize the stock price. This goal translates into a straightforward decision rule for managers: only take actions that are expected to increase the wealth of shareholders. Although that goal sounds simple, implementing it is not always easy. To determine whether a particular course of action will increase or decrease shareholders' wealth, managers have to assess what return, that is, cash inflows net of cash outflows, the action will bring and how risky that return might be. The figure here depicts this process. In fact, we can say that the key variables that managers must consider when making business decisions are return, cash flows, and risk.